You don't need a down payment. You don't need a contractor. You don't need a tenant calling you at 2 a.m. because the toilet is broken. And you definitely don't need a mortgage with 7% interest. Yet you can still own prime real estate, apartment buildings, shopping centers, data centers, even cell phone towers, and collect dividend checks every single month. How? Through two simple tools that 90% of investors have never heard of: REITs and real estate crowdfunding. If you stay until the end of this video, I'm going to show you exactly how to build a passive real estate portfolio from scratch, starting with as little as $50 that targets 12% dividend yields, no property management, no maintenance, no stress. Just mailbox money from some of the largest real estate assets in the world. My name is your name, and today we're going to make you a real estate mogul without ever buying a house. Let me start with a story that changed my entire perspective on real estate. 5 years ago, I wanted to invest in real estate, but I lived in a high-cost city where a starter home cost $800,000. I didn't have a down payment. I didn't want to be a landlord, and I definitely didn't want to take out a massive mortgage. So I did nothing. I missed out on a real estate boom that saw prices rise 40% in my area. Then a friend introduced me to REITs, real estate investment trusts. I put $5,000 into a REIT that owns cell phone towers. In the last 4 years, I've collected over $2,200 in dividends, and my shares have appreciated 35%. I now own a slice of thousands of properties across the country, from shopping malls to data centers to apartment complexes. I've never unclogged a single toilet. That's the power of real estate without buying a house. And today, I'm going to give you the exact roadmap. Part 1. REITs, the stock market's real estate secret. REITs are companies that own, operate, or finance income-producing real estate. By law, they must distribute at least 90% of their taxable income to shareholders as dividends. That's why REITs pay such high yields compared to regular stocks. The average REIT in 2025 paid a dividend yield of about 4%, far exceeding the S&P 500's yield of around 1%. But some REITs pay much more. We're talking 5% to 8% and even higher for certain sectors. Now let's look at historical returns. From 1972 through 2024, REITs returned an average annual return of 12.6% compared to 8% for the S&P 500. That's the data. Over 50 years, REITs have crushed the broader stock market. And remember, that 6% includes both dividends and share price appreciation. Let me give you a concrete example. One of the most famous REITs is Realty Income, ticker symbol O. It's called the monthly dividend company because it pays dividends every single month, not quarterly like most stocks. As of 2025, Realty Income had a dividend yield around 5.6%. It has increased its dividend for over 30 consecutive years, and it owns over 15,000 commercial properties, retail stores, warehouses, convenience stores, all leased to tenants like Walgreens, FedEx, and Dollar General. You can buy it in your brokerage account today for the price of a few dozen shares. That's real estate ownership for the price of a dinner out. But here's where it gets even more interesting. Different types of REITs offer different yields and growth profiles. Here are the main categories you need to know. Equity REITs own physical properties. They generate income from rents. That's what most people think of when they think of REITs. Mortgage REITs, or MREITs, don't own properties. They lend money to real estate owners or buy mortgage-backed securities. They make money from the spread between the interest they earn and what they pay to borrow. These can be very high yield, sometimes 8% to 12%, but they're also more sensitive to interest rates. Then you have specialized REITs that focus on niche sectors. Cell phone towers, like American Tower, ticker AMT, data centers like Digital Realty, ticker DLR, self-storage like Public Storage, ticker PSA, and healthcare facilities like Welltower, ticker WELL. These sectors often have higher growth potential because of long-term trends like 5G expansion and cloud computing. Here's a powerful stat. REIT dividends averaged over 4% in 2025, while the S&P 500's dividend yield was approaching just 1%. That means for every dollar you invest, a REIT is paying you 4 times more cash than a typical stock. And if you reinvest those dividends, the compounding effect is enormous. Now, let me show you how to build a REIT portfolio that targets high dividends. This is a real strategy you can implement today. The Core Satellite REIT Portfolio. Start with a core holding of a low-cost REIT ETF. The Vanguard Real Estate ETF, ticker VNQ, holds hundreds of REITs across all sectors. Its expense ratio is just 0.12%. It pays a dividend yield around 4% to 4.5%. This gives you instant diversification across property types and geographies. Put 50% to 60% of your REIT allocation here. Then add satellite holdings of individual high-yield REITs. Here are 3 examples with real numbers from 2025. Realty Income, 5.6% yield, monthly dividends, 30-plus years of dividend increases. Put 15%. EPR owns entertainment properties like movie theaters, ski resorts, and water parks. Yield around 4% to 5% as of 2025. STAG Industrial, STAG, owns single-tenant industrial buildings like warehouses and distribution centers. Yield around 4% to 5% with monthly dividends. You can also look at mortgage REITs for even higher yields, but understand the risk. AGNC Investment Corp., ticker AGNC, is a large mortgage REIT that has historically yielded 10% to 12%, but its share price can be volatile. Use these for a small portion of your portfolio, maybe 10% or 15% if you have a higher risk tolerance. Now let's talk numbers. If you invest $10,000 in a portfolio of REITs with a weighted average dividend yield of 6%, you'll collect $600 in annual dividend income. If you reinvest those dividends, after 20 years with 6% appreciation plus compounding dividends, that $10,000 could grow to over $50,000. That's real estate wealth without ever buying a property. Part 2. Real estate crowdfunding, the new frontier of passive income. REITs are great, but they have limitations. They trade on stock exchanges, which means their prices go up and down with market sentiment, not just with the value of their properties. That creates volatility. Also, most REITs are large, institutional-grade portfolios. You can't pick a specific apartment building in a specific city to invest in. Enter real estate crowdfunding. These platforms allow you to pool your money with other investors to fund specific real estate projects, apartment renovations, new construction, fix and flips, or commercial developments. In return, you earn a share of the rental income and potential appreciation at sale. The market for real estate crowdfunding is exploding. In 2025 alone, it was expected to reach over $20 billion. Returns typically range from 8% to 12% annually, depending on whether you invest in equity, ownership, or debt, loan-based deals. Some platforms even target yields of 10% to 12% or higher. Here's what the data shows. Interest rates across crowdfunding platforms span from 4% up to 21.1%, averaging around 11.6% across the market. That's significantly higher than what REITs typically pay. Let me break down the 2 main types of crowdfunding investments. Debt-based crowdfunding. You act like the bank. You lend money to a developer or property owner at a fixed interest rate, typically 7% to 12%. You receive regular interest payments, and at the end of the loan term, you get your principal back. This is lower risk because you have a legal claim to repayment before equity investors. Equity-based crowdfunding. You become a part owner of the property. You share in rental income, usually distributed as dividends, and in the profit when the property is sold. Returns can be higher, sometimes 12% to 15% or more. But you also take on more risk because if the project fails, you could lose your entire investment. Now, let's look at some of the most popular platforms in 2025 and 2026. Fundrise is the most accessible platform for beginners. You can start with as little as $10. They invest your money in a diversified portfolio of private real estate projects. Historically, Fundrise has delivered average annual returns of around 7% to 12%, with dividend yields around 4% to 5%. Their lowest annual return was 7.31% in 2020, and their highest was 22.99% in 2021. Since 2014, returns have averaged 9% to 12% per year. Fundrise is open to non-accredited investors, meaning almost anyone can join. CrowdStreet focuses on commercial real estate deals, office buildings, retail centers, industrial properties. They target returns of 8% to 12% or higher. However, most deals require you to be an accredited investor, meaning you have a net worth over $1 million or income over $200,000 per year. Minimum investments are often $25,000 or more. This is for more sophisticated investors, but the potential returns can be higher. YieldStreet offers a range of alternative investments, including real estate debt funds that target 8% to 12% annual returns. They have lower minimums than CrowdStreet and are open to non-accredited investors for some offerings. Their real estate funds focus on residential and commercial bridge loans, short-term financing for property renovations or acquisitions. Realty Mogul is another platform that offers both REITs and individual deals. They have a public, non-traded REIT that targets annual returns of 6% to 8% with monthly dividends. They also offer individual equity and debt offerings with projected returns of 8% to 12%. Now let me give you a real example of how crowdfunding income works. Imagine you invest $5 Zuzu in a debt-based offering on a platform like YieldStreet. The offering is a $1 million loan to a developer renovating a 20-unit apartment building. Interest rate, 10% per year, paid quarterly. Your $5,000 share earns you $500 in interest per year, $125 every 3 months. After 18 months, the developer repays the loan and you get your $5,000 back. That's $750 in total interest on a $5,000 investment, a 15% return in 18 months. That's real estate income without buying or managing anything. Now, what about that 12% dividend strategy I promised? Here's how to build a portfolio that actually targets 12% yields. The 12% dividend portfolio blueprint. Asterisk. Allocate 40% to high dividend REITs. Focus on mortgage REITs and specialty REITs in high-yield sectors like office and retail that were yielding 5% to 8% in 2025. Use ETFs like VNQ for core exposure and add individual names like Realty Income, O, and AGNC for yield. Allocate 30% to crowdfunding debt offerings. Look for debt-based deals on platforms like YieldStreet, Fundrise's debt funds, or Realty Mogul that target 9% to 12% annual interest. These provide steady cash flow without as much volatility as equity investments. Allocate 20% to crowdfunding equity offerings. Use platforms like CrowdStreet, if accredited, or Fundrise's REITs, open to all, that target 10% to 15% total returns, including both income and appreciation. This portion has more risk but higher upside. Allocate 10% to mortgage REITs and private funds. Use funds like AGNC or private offerings from platforms like YieldStreet that target 10% to 14% yields. This is the highest risk portion, so keep it small. With this blend, your weighted average yield could easily reach 9% to 12%, depending on the specific deals you select. A $50,000 portfolio at 10% yield generates $5,000 in annual passive income. At 12%, that's $6 per year. That's a serious supplement to your regular income or a solid foundation for early retirement. Part 3. The risks you must know and how to avoid them. Asterisk. Let me be completely honest. Real estate crowdfunding is not without risk, and you need to understand these risks before you invest a single dollar. First, illiquidity. When you invest in a crowdfunding deal, your money is often locked up for years, typically 3 to 7 years. You cannot sell your shares on an exchange like you can with a REIT. If you need cash for an emergency, you might be stuck. The only way out is to find a secondary market buyer, which may not exist. Never invest money you might need within the next 5 years. Second, platform risk. If the crowdfunding platform goes bankrupt, your investment could be tied up in legal proceedings for years. Always invest through reputable, well-established platforms like Fundrise, CrowdStreet, or YieldStreet. Check their track record and read their SEC filings. Third, project failure. Not every real estate project succeeds. A developer could go over budget, the market could turn, or the property might not rent as expected. In 2025, legal action against crowdfunding platforms was increasing as investors confronted losses from failed or underperforming projects. Always diversify across multiple projects, multiple platforms, and multiple property types. Never put all your eggs in one basket. Fourth, fees. Crowdfunding platforms charge management fees, usually 1% to 2% per year. Some also charge acquisition fees, disposition fees, or performance fees. These eat into your returns. Always read the offering documents carefully and understand all fees before investing. Fifth, lack of price transparency. With public REITs, you can see the share price every second of every trading day. With private crowdfunding deals, valuations are done periodically, often quarterly. The price you see may not reflect market reality. In a downturn, properties may be worth far less than their last appraisal. Now, let me give you a real story that illustrates both the opportunity and the risk. A viewer named Tom invested $25,000 in a CrowdStreet deal for a new apartment complex in Austin, Texas. The projected returns were 14% IRR with a 9% cash-on-cash yield. Then interest rates rose, construction costs skyrocketed, and the project was delayed by 18 months. Tom received reduced distributions. Eventually, the project completed, but the returns were only 7%, still positive but far below projections. Tom learned the hard way that projections are not guarantees. He told me, "I still made money, but I wish I had diversified across more deals instead of putting so much into one." The lesson? Diversify across platforms, projects, and property types. Use REITs for core, liquid exposure. Use crowdfunding for satellite, higher yield exposure. And never invest more than 5% to 10% of your total portfolio in any single crowdfunding deal. Part 4. REITs versus crowdfunding. Which one is right for you? Asterisk. Let me give you a simple comparison to help you decide. Are liquid. You can buy or sell them any day the stock market is open. Crowdfunding investments are illiquid. Your money is locked up for years. REITs have low minimums. You can buy one share for the price of the stock. Crowdfunding often has minimums of $500 to $10,000 for equity deals. Though some platforms like Fundrise go as low as $10, REITs have lower returns but lower risk. The average REIT historically returned 12.6% annually, but that includes periods of significant volatility. Crowdfunding targets higher returns, 8% to 12% or more. But with higher risk and less certainty, REITs are public and transparent. You can see their financial statements, property holdings, and management compensation. Crowdfunding deals are private, with less disclosure and less regulatory oversight. REITs are diversified by law. They must hold at least 100 properties in many cases. Crowdfunding allows you to invest in a single property, which is higher risk but also potentially higher reward. My recommendation for most investors: start with REITs. They are the simplest, safest, most liquid way to get real estate exposure. Once you have a solid core portfolio of REITs, say $10,000 to $25,000, then consider adding crowdfunding for extra yield and diversification. But don't let crowdfunding become more than 20% to 30% of your real estate allocation. And never invest money in crowdfunding that you might need within 5 years. Part 5. Tax considerations. Don't forget about Uncle Sam. Here's something most YouTube videos won't tell you. REIT dividends are typically treated as ordinary income for tax purposes, not qualified dividends. That means you pay your marginal income tax rate on them, which could be as high as 37% for high earners. However, you may qualify for the Qualified Business Income (QBI) deduction, which allows you to deduct up to 20% of your REIT dividend income. This reduces your effective tax rate. Always consult a tax professional, but know that this deduction exists. Crowdfunding distributions can be more tax efficient. Because real estate generates depreciation, some of your distributions may be treated as return of capital rather than taxable income. Return of capital reduces your cost basis, but is not taxed immediately. That means you keep more of your money now and pay taxes later when you sell. This is a significant advantage of private real estate investments. One more tax tip: hold your REITs in a Roth IRA or Roth 401A if possible. Then all your dividends grow tax-free and can be withdrawn tax-free in retirement. That's the ultimate hack. I covered this in detail in Script 1 and Script 6. Go watch those videos if you missed them. Now, let me give you the exact step-by-step plan to start investing today. Do this right now. After this video ends, Step 1. Open a brokerage account if you don't have one. Vanguard, Fidelity, or Schwab. Do it now. It takes 15 minutes. Step 2. Buy a REIT ETF as your core holding. For 2026, I recommend VNQ Vanguard Real Estate ETF or SH Schwab REIT ETF. Put at least 50% of your real estate allocation here. The expense ratios are microscopic, around a 0.07% to 0.12%. Step 3. If you want higher yield, add individual REITs. Research companies like Realty Income, Stag Industrial, and AGNC Investment, AGNC. Start small, maybe 10% of your portfolio in each. Use the stock screener in your brokerage to compare yields and payout ratios. Step 4. Sign up for a crowdfunding platform. If you're a beginner, start with Fundrise. Minimum investment is $10 to $500 depending on the plan. Choose their flagship fund or income fund, which target 9% to 12% returns. Connect your bank account and transfer money. Turn on automatic reinvestment so your dividends buy more shares. Step 5. If you have more capital and are an accredited investor, explore CrowdStreet or YieldStreet. But start small, no more than $5,000 in your first deal. Read every page of the offering document. Understand the fees, the timeline, and the worst-case scenario. Step 6. Set up automatic contributions. Even $50 a month to your REIT ETF will add up over time. Real estate wealth is built slowly, not quickly. Patience is your superpower. Step 7. Reinvest all dividends. Turn on DRIP, dividend reinvestment, in your brokerage account for REITs. For crowdfunding platforms, check the box to automatically reinvest distributions. This is how you harness the power of compound interest. Einstein called it the eighth wonder of the world. I call it the only way to build real wealth without trying. Now, let me leave you with a story that will stick with you. A viewer named Sophia was a single mom, 35 years old, working as a nurse. She had no money to buy a rental property. She started investing $100 a month in VNQ, the Vanguard REIT ETF. 3 years later, she had about $4,200 and was receiving $15 a month in dividends. That doesn't sound like much, but she kept going. She added a small Fundrise account with $500. That generated another $4 a month in distributions. Total $19 a month. She told me it's not life-changing yet, but every time I get that dividend notification, I smile. I own real estate. Me, a nurse. No landlord headaches, no mortgage. Just passive income. 5 years from now, her $100 a month plus reinvested dividends will be worth over $10,000. In 10 years, over $25,000. In 20 years, over $80,000. And she'll be receiving thousands of dollars every year in dividends. All from money she barely noticed leaving her paycheck. That's the power of starting small and staying consistent. You can be Sophia. You don't need to be rich. You don't need a down payment. You just need the discipline to start and the patience to stay the course. Now, here's your challenge for today. Right after this video, open your brokerage account or create a Fundrise account. Put in $50, buy VNQ. That's it. Just take one action then. Come back tomorrow and do another $50. Build the habit. The money will follow. Comment below. I'm buying my first REIT this week, and tell me which one. I'll personally reply to the first 50 comments. Hit like if you're ready to stop renting your wealth to landlords and start owning your share of the American real estate market. Subscribe and turn on notifications. In the next video, I'm going to reveal the best way to save for your child's college without getting crushed by tuition costs. It's a battle between 529 plans and Roth IRAs, and the winner might shock you. The old way of real estate investing required money, time, and stress. The new way requires a smartphone, an internet connection, and the knowledge you just learned. You have the knowledge. Now go take action. I'll see you in the next video.